Welcome back to Morning Markets on Friday, the 7th of May. George Bell here, investment analyst, to bring you up to date on the key market moves over the last 24 hours. Turning first to equity markets, here in the UK, you had the FTSE 100 up around 52 basis points, FTSE 250 around 47 basis points, and the small cap sector up around 0.49%. In the US, the Dow Jones Industrial Average, strong day there, up 0.93%, S&P 500 up 0.82%, and the Nasdaq up 0.37%. Europe was relatively flat, and Asia had China, which was actually down around 1.25% despite the strong PMI data which we did see there. Japan with the Topix index that was up around 0.29%, and in South Korea indices were up around 0.58%. In terms of bond markets, UK gilt yields with 10 and 30 years to maturity were in around 2 and 1 basis points on the day, taking the yield to 0.79% and 1.32%. We'll cover the intraday movements very shortly there. In terms of US Treasuries with 10 and 30 years to maturity, little change there. Yields settling at around 1.57 and 2.24%. Global bonds, which is a blend of corporate and government bonds, were up around 0.2% on the day. It was a strong day for commodities. Overall commodity baskets up around 0.7%. Within that, precious metals such as gold and silver were up 1.5 and 3% on the day. Brent crude, in terms of oil, that actually pulled in just over 1% there to 68.29 per barrel after a strong week within the oil markets. Within currency markets, it was a stronger day for sterling, up 0.3% against a trade-weighted basket of foreign currencies. So sterling against the dollar came in at around 1.39, sterling against the euro around 1.15. In the morning investment meeting today, we focused on the decision and the guidance from the meeting of the Bank of England's Monetary Policy Committee yesterday. As anticipated, the Monetary Policy Committee did vote to unanimously keep interest rates at 0.1%, where it's been since March of last year. The committee also voted 8-1 in favour of maintaining the current target of government bond purchases through the quantitative easing programme, which they unleashed last year at £875 billion, but will taper the pace of purchases from the current rate of £4.4 billion per week to £3.4 billion to ensure that they meet that target accurately. They'll be closely monitoring financial conditions and economic health using high-frequency observations as they're poised to open channels back up if they're required to support the successful function of markets and the achievement of policy objectives around inflation levels and employment levels. In other words, they remain very supportive there. The majority vote on the bond purchase programme was 8-1. The outlier there was the notorious Monetary Policy Committee hawk, Andy Haldane. A hawk is really a term which is used to reflect people who are more acutely sensitive to inflation, therefore typically favour tighter monetary policy, higher rates, tighter QE policy, the opposite to that being what you call a dove. Haldane, who is a long-standing member of the MPC and chief economist at the Bank of England, voted to taper back the target to of the current programme, some £50 billion, proposing to take the total target down from £875 billion to £825 billion. Why is that? Well, he's convinced with the strength of the UK economic rebound. The conviction is supported by the success of the vaccination programme and the improvement in high-frequency activity data, pent-up demand, and therefore believing that the level of monetary policy support, which is already there and already set as a target, it's actually not required. Don't need to use that full purse up at this point in time. Haldane's provided debate, he's provided challenge within the bank in his tenure, which has spanned over 3 decades now, but is set to move on to pastures new at the end of June. In terms of the economic outlook, the committee revised their forecasts for year-over-year growth in GDP in 2021 up to 7.25% from 5% in February, so a strong uplift there. And whilst they revised down the forecast for GDP growth in 2022 to 5.75 from 7.25, the projected level of GDP in 2023 is some 1% higher than where they were expecting in February. Unemployment's expected to be 5.2%, so stronger than the 7.8% which they previously predicted. Back to the point on inflation, the committee left markets under no illusion that rate hikes are not in the agenda in the near term, making clear they view the forthcoming inflation prints, which will be higher, or short term, the transitory, and will moderate towards target over the next 12 months. They expect CPI inflation to peak at around 2.5% in Q4 of this year, moderating to just under 2% in the second quarter of 2023, and then around 1.9% in the second quarter of 2024. In terms of intraday action, you can see on screen now the UK 10-year bond yield. They had a sharp pull in prior to the announcement and then spiked back up, peaking at around 0.83% as investors digested the prospect of a moderation in the pace of purchases. But it did come in and pull back in towards 0.79% towards the end of the day. Already today, we've seen, as I mentioned, strong manufacturing and service PMI data from China beaten analyst expectations, another signal of the strength of the recovery as global economies open up. Later today, we'll see US unemployment reports. Analysts are expecting levels of around 5.7%, so down from the previous month of 6%. Yesterday's initial jobless claims did offer some comfort in the improvement there, fallen some 92,000 week on week to 498,000, which is the lowest levels which we've had since the pre-pandemic. Thank you for watching. Have a great weekend. We look forward to bringing you up to date on Monday on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.